In this video, we are going to connect two important ideas. First, we'll talk about measurement in financial accounting per the conceptual framework. Then we will use one of those measurement ideas as a bridge into the time value of money. One thing that can make financial accounting confusing for some students is that we don't measure every account the same way. US GAAP uses what we call a mixed attribute measurement model. That means different assets and liabilities may be measured using different measurement attributes, depending on the nature of the item and the accounting rule that applies. The first measurement attribute is historical cost. This is the original transaction value. In simple terms, it's what the company paid for when the asset was acquired, or what was received when the liability was created. The second is fair value. Fair value is a market-based idea. It represents the price that a third party would be willing to pay or accept in an orderly transaction. The third is net realizable value. This is the estimated selling price of an asset reduced by the costs necessary to sell it. Very relevant with inventory accounting. The fourth is current replacement cost. This asks how much it would cost today to purchase or reproduce the asset. And finally, we have present value of future cash flows. This is often used to approximate fair value when we are dealing with predictable cash flows that occur over many years. That final measurement attribute is where we will now turn our attention. If you have had some exposure to the time value of money, you may have heard it summarized this way: a dollar today is worth more than a dollar tomorrow. That phrase is useful, but let's be a little more precise. The idea is that money in the present is worth more than the exact same amount of money received in the future, and there are several reasons for this. First, inflation. Over time, prices generally tend to rise. That means that the same dollar may buy less in the future than it can buy today. Second, opportunity cost. If you have money today, you can use it today. You can invest it, pay down debt, buy inventory, or use it for some other purpose. But if the money is tied up until a future date, you give up those opportunities. Third, risk. The future is uncertain, and a promised future cash flow may not actually arrive, or it may arrive under a different circumstance than expected. So, to slightly distort a familiar proverb, a dollar in the hand is worth more than a dollar in the bush. The time value of money shows up in several major areas of financial and managerial accounting. Let's take lease accounting as an example. Think about an airline with a large fleet of aircraft. Many of those aircraft may be leased, and those lease agreements may involve payments stretching far into the future. When the company is going to report a lease liability, it doesn't simply add up every future payment and put that total on the balance sheet. Instead, it reports the present value of those future lease payments. The same idea applies in managerial accounting. Imagine Disney is considering adding a major new roller coaster. Management's not only thinking about this year's cost and this year's revenue, they are thinking about a large cash outflow today and then expected cash inflows for many years into the future. To evaluate that decision, they need to compare cash flows occurring at different points in time. You will also see the time value of money in bonds, investments, pensions, impairment testing, and many other accounting topics. So this is a tool that will keep coming back. And beyond accounting, this concept matters for your own life. When you buy a car or take out a mortgage, compare financing offers, or invest for retirement, you are dealing with the time value of money. You may not sit down every day and calculate present values, but on the days when these ideas are relevant, they really matter. And my hope is that this material helps you become a better accountant, but also a more confident decision maker. If you understand interest rates, payments, and present values, you are going to be in so much stronger position when you talk with lenders, salespeople, financial advisors, or anyone else involved in a major financial decision. When you work through a time value of money problem, it helps to think in terms of 5 possible inputs. The first is the discount rate. This is the interest rate that applies to the situation. Sometimes it is explicit, like the interest rate on a loan. Other times it is implied by market conditions, like the rate used to price a bond. The higher the discount rate, the less a future dollar is worth today. The second input is the number of periods. And that's not always the same thing as the number of years. As a quick note, you do have to pay attention to when interest compounds and when payments occur. For example, a 30-year mortgage usually has monthly payments. So the number of periods is not 30, it's 3 times 12 or 360 monthly periods. And you need to divide the interest rate by 12 because the interest compounds on a monthly, not annual basis. The third input is payment. This refers to equal recurring cash flows. Some problems have payments, some do not. If you put one lump sum into investment and leave it there for 6 years, there's no recurring payment. And as another note, it's important to pay attention to the timing. Payments can occur at the end of each period or at the beginning, and that timing difference affects the present value. And the fourth input is present value. This is what a future amount or a future stream of cash flows is worth today. The fifth input is future value. This is the value at some future point in time. For some loans, the future value is 0 because the loan is fully paid off. For other arrangements, there may still be a future amount due at the end. In many time value of money problems, you are given 4 of these inputs and asked to solve for the 5th. In Accounting 3010, we are going to focus on present value calculations. And there are several different legitimate ways to solve time value of money problems. You can use formulas, which is like opening the hood of the car and looking directly at the engine. You could use a financial calculator, which is what many business students have used historically. You could use Excel, which is probably the most practical method in many professional settings. Or you could open up a textbook and use present value tables, where you look up a discount factor based on the rate and the number of periods. In this class, we are going to use a simplified discount factor approach. I will usually provide the relevant discount factors, and your job is to understand which factor applies and how to use it. That means the hard part is not memorizing formulas, the hard part is correctly identifying the pattern of cash flows. So as I mentioned earlier, we will focus our attention on present value calculations. There are 3 main discount factors I want you to recognize. First, the present value of $1. This is used for a lump sum. It tells us how much $1 received n periods in the future is worth today, given a discount rate. Second, the present value of a $1 annuity. This is used when there are equal payments at the end of each period. In other words, it values a stream of recurring future cash flows. Third, we've got the present value of a $1 annuity due. This is similar to an ordinary annuity, except the payments occur at the beginning of each period instead of the end. So when you see a problem, ask, is this one singular future amount, or is this a stream of equal payments? And if it is a stream of payments, do they happen at the beginning or the end of each period? Let's look at a few examples to practice how this is to be done. With the problem in that top right-hand corner, we are assuming an annual discount rate of 6%, and we want the present value of a $10,000 lump sum to be received 5 years from today. The key phrase here is lump sum. This is one future cash flow. Because it is one future amount, we use the present value of $1. We are told that for 5 periods at 6%, the present value of $1 is a factor of 0.747. So we can take $10,000, multiply it by that factor, and that gives us $7,470. In plain English, this means that receiving $10,000 5 years from now is economically equivalent to receiving $7,500 today, assuming a 6% annual discount rate. Now let's look at example 2. Here, a company is paying $50,000 today and then makes equal payments each year. For this example, we will treat this as 5 total payments with the first payment occurring today. The important clue is that the first payment is happening today. That means this is not an ordinary annuity, it is an annuity due. The discount factor for a present value of $1 annuity due with 5 periods and a 6% discount rate is 4.465. So we multiply 50,000 by 4.465, and that gives us $223,250. Notice what the factor is doing. Obviously, they're not literally 4.465 payments. It is converting 5 payments occurring at different points in time into one present value amount. Now let's look at the third example. On January 1st, a company purchases an investment and expects to receive $1,000 on June 30th and December 31st each year for 5 years. The annual discount rate is still 6%. This example requires one extra step because the payments are semi-annual. There are 2 payments each year for 5 years, so the number of periods is actually 10. We also need to make an adjustment for the discount rate. While an annual discount rate is 6%, since the cash flows are occurring every 6 months, we need to use a 3% semi-annual discount rate. Because the payments occur at the end of each 6-month period, we will use the present value of a $1 annuity factor. So for 10 periods at 3%, that factor is 8.530. We multiply $1,000 by it and that gives us $8,530. The big takeaway is that the time value of money problems are mostly about pattern recognition. Identify the cash flow pattern, identify the timing, and match the correct discount factor, then you just multiply. And now you should be prepared to tackle accounting treatments that involve cash flows multiple years in the future.